I thought this was a compelling comment, and that is that, David, that waiting for the next recession is not an investment strategy.
That's right.
And we're seeing that, aren't we? Because it's been so long that we've been in this business cycle, and we figure sooner or later. So if you really believe that in 19 or 20, 2019 or 2020, it's tough to stay long unless you say, you know what, that is not an investment strategy. I'm not going to base my
and you shouldn't. And maybe this.
But it's so easy to do. It's got to. Doesn't it have to come eventually?
Yeah, well, I don't think it's going to come anytime soon.
You said neither year, not this year or next year.
Next year. I do think this is going to be an economic expansion that goes on for 12 to 15 years. Joe, you've said to me in the past, why not 16 years or longer? The UK had a 16-year expansion from 1992 to 2008. And what you see, though, is you just see valuations right now. I know they're not cheap, but valuations still reflect that plenty of investors think either a recession is coming soon or that interest rates are still going to jump upward sometime soon.
That's your other point. And I think, how long has Australia had an expansion?
27 years. Yeah, that's right. Yeah. So expansion.
But your point about the 10-year, that it will not materially exceed 3% for the rest of this cycle, allows valuations to stay not necessarily stretched if rates stay this low, right?
Right. So the S&P is currently trading just slightly above 16 times the $170 of earnings we're expecting for this year.
Okay.
But if the 10-year Treasury yield stays below 3%, I would expect the PE, or at least a fair PE, should be 18 to 20.
So that's the key. We're back to just watching Treasuries, and what's the alternative?
Right. We're back to is there really a compelling alternative? There isn't a compelling alternative if you want a real return after taxes, after fees. You pretty much have to turn to equities. And I think the whole world feels that way, and they're looking toward U.S. equities as a source of stability and at least, I would argue, reliable earnings growth. Some are making the argument a profit recession is upon us. I disagree with that. I would agree with the idea that there's a profit recession risk emanating from energy, materials, and industrials, but we still see the tech sector, most of the consumer sectors, and even the financial sectors having up profits at a healthy pace in 2019.
Well, I'd love to get back to if I didn't need to worry about the Fed. Okay, I put that aside because that's what caused December, really.
Right.
I think. And if I didn't have to worry about China, and I think maybe we do need to worry. I don't know how that works itself. Then I could get back to worrying about Italy or Europe or the dissolution of the EU or Brexit or the things the garden variety worries we used to have.
So we're feeling a lot better about the Fed because the Fed sees that they are basically at or very, very close to the neutral Fed funds rate. China, we think China's already gone through the worst of its deceleration. And what's interesting is that they've gone through the bulk of the deceleration, made a transition, not entirely, but in large part toward more consumption from investment spending and credit. But what's interesting is that the renminbi did not depreciate in a big way over the past handful of months. Right now, it's a bit strong at 6.7. I think it may weaken a little bit to 6.
It's been propping it up.
But the point is that it never depreciated in a big way. That's opened the floodgate for foreign investors into emerging market Asia. We think that market has the most upside.
That's an artificial way of looking at things, though. Because they've been propping it up instead of the opposite of what they've been doing for years.
They've been looking to have a firm currency to attract investment, but not too strong of a currency that it inhibits their ability to export. I think just being shy of 7 is the perfect spot for renminbi.
Now, okay, what's DWS, Bianco? What is that?
Well, we're a global asset manager.
Where were you before?
Deutsche Bank.
For a long time, right?
For a long time. We're an asset manager still.
What happened with DWS? When did that happen?
I did that a couple of years ago. So
really? Has it been that long? Right? So because you can come on Squawk Box, doesn't matter really where you are. They'll hire. You probably get big bonuses to move because you're still going to come on as David Bianco. You're not David Bianco of Deutsche Bank. You're David Bianco now.
I appreciate that. I enjoy spending time with all three of you.
Like Bernstein did the same thing. He was Merrill, and then he said, I don't need Merrill anymore because I'm Richard
Bernstein. I have quite a bit of respect for, Richard. Yeah, and the point is, yes, I do. Yeah.
Such an instigator. You were such an instigator.
But the point is, Joe, being on the buy side, the asset management side, it's allowed me to have I get to listen to more people from the sell side.
Buy side, they'll
take
any day. Those sell side guys, man, they just got to be linguists, to never really say anything.